All right. Hey, everyone. It is Investment Tuesday here. As you can see, I am not home. I am away from home. I am visiting in Southeast Asia, traveling through the area, doing a little bit of research, a little bit of understanding, getting some sense of how things are being viewed across the world through this trade war, through tariffs, through everything that is happening. But that's not the subject really of today's video. Today, we're going to talk about something that I know what people are going to say. Paul, you are the boy that cried wolf, and we are not going to pay attention. And you know what? That is okay with me. People want to care, you want to lose out because you think that, I don't know, people can have like perfect timing, perfect records. Hey, that's fine with me. But today we are going to talk about Bitcoin and why I believe it's about to go parabolic. It's about to go parabolic. What does parabolic mean? It means straight up, straight up, straight up, rocket surge up. And I know what's going to happen. I'm going to predict the future. After it goes parabolic, people will come to buy and say, well, Paul, how much more can it go? But at low prices, nobody's a buyer. Nobody's a buyer. Nobody wants it because you know what? It hasn't gone up yet. And people always want it at the low price, but after it's gone up. So today I'm going to make my case why, in my opinion, my judgment, in my view, my take on the world, not guaranteed, not a certainty, Bitcoin's about to go parabolic, and I believe it will hit my price target, which I laid out and have been laying out for this halving cycle, which is $1 million. The thing that was missing then was like, what would trigger this seemingly enormous move, right? From like, you know what? I mean, at the halving point, we're at 65,000. The idea of $1 million for each Bitcoin seemed preposterous, seemed ridiculous, seemed really out of bounds. But yeah, you now throw in the trade war, you throw in that, oh, you've got enormous, like, historic, epochal changes going on to the world's financial system, to the world's trading system, to currencies, interest rates. It's all up in the air. Yeah, that is the trigger. That is the catalyst that's out there. And we'll point you to things that I'm seeing right now that you piece it together, at least from my perspective. And remember, what I do is I look at these things, right? And people want guarantees. People want certainties. They want to know. Well, the only way you know is after the fact. If you want to buy for big gains, you got to do it, before, which means there's risk, but hey, you got to put yourself out there a little bit. I mean, the rewards go to those who are willing to go out on a limb. All right. Before I get into the details, let me keep the lawyers happy and fed, which is to give you my legal disclaimers and disclosures, which is that this video and the content from ATG Digital is not investment or financial advice. It is presented to you as my opinion, my view, my take on the world. Use it as information, engagement, or entertainment. I'm sensing this one will be used as entertainment by some number of people, and I can predict the troll comments that are going to come. So bring them on, bring them on. All right, all ATG Digital content may contain errors, oversights, and mistakes. Understand that investment operations, which is what? Buying or selling crypto, stocks, options, whatever, can lead to the loss of your principal, meaning that you can lose money. Next, the owners, employees, contractors of ATG Digital own, trade, transact, and securities and mentioned in this video, and all content from ATG Digital. We do not take money from crypto promoters, from company managements, or from influencer agencies to recommend crypto tokens or stocks or any of this crap. This is widely done by many, many people. We do not do this for better and for worse, for gain and for loss. What you get from us is our unique, independent point of view. Next, this is the various content that we put out. We have the Substack that goes out any day that the market is open, the stock market that is. So for example, Memorial Day, we would not have put out a Substack with something in it. We do put something out saying, hey, it's Memorial Day, we're closed. But nonetheless, the Substack, and we got the Bald Man Speculating podcast and YouTube, which you're watching this on. So we put out a lot of stuff. We are active on social media. We've got the X account, we've got Instagram, we got Facebook. So we are widely available. Finally, we have subscriptions that you can get from ATG Digital, which is my company. And subscriptions begin at $9.99 per month and goes up from there. And if you have been watching our videos, you know our point of view. We look at growth stocks, we look at crypto, we look also at opportunities. In other words, bottom line, we're looking to make big money. Right? I mean, that's our goal. Our goals, and that's the world of opportunity. We're not like focused on any single sector. We're going to go where the opportunity is and where we have the highest likelihood of making the largest amount of money. That's our goal. All right. And in my opinion, right, and some people think that it's a cop-out to say this, in my opinion, my judgment. But you know what? There are lots of folks that think that because they're watching a YouTube channel and, okay, hey, this Paul guy, he's run a hedge fund, he's been, in Wall Street, it must be that this is a guarantee. No, it's my opinion, it's my take. That's true for anybody that is making any sort of like content, anybody that's showing up on CNBC, anybody preferring their opinion. It's just their opinion. It's not a guarantee, right? So well, sometimes like whatever, I tell people, hey, some stock might do this and it goes wrong. They're like, Paul, you said this and it didn't happen. Well, you know what? Tough luck. You pays your monies, you takes your chances. If you don't like that, don't watch, unclick, unsubscribe, move on to somebody that will lie to your face and guarantee you that things are going to happen exactly as they think. Nonetheless, I can say this much. I do my research. I do my work. I do have vast experience, and we've gotten a lot of calls right. We've gotten a lot of calls right in the past, even with, if you go to Bitcoin. So go through the channel and you can decide for yourself what you think. But nonetheless, my view is we are setting up for a parabolic run. What is a parabolic run? I can't draw on the screen, but essentially it means like, just like a straight, like it's just like a very rapid movement higher that just draws skepticism, that draws people's, for at first at least, people are skeptical. They're like, no, that's not this. It's going up too fast, too much, too fast. No, it can't be too. And then at the very end, somewhere near the peak, everybody gets FOMO and gets in, and then and you get a big burst, and then they get trapped in at high prices, and then they end up selling out at lows for very low prices. But Bitcoin, my judgment, is setting up for a parabolic run. I got to get some notes here so that I keep on track here. So why? Well, let's do some chart analysis. And let me add a few charts. What you're looking at is a chart of the yield, which is what? The interest rate for the 30-year bond, right? Issued by the U.S. government. Ugh, my screen has just timed out. That really sucks. Nonetheless, what you are looking at is at the interest rate for the 30-year bond. Yeah, what is happening is that it is now above 5%, and that is a 5-year weekly chart of the 30-year bond yield. Now, what is this 30-year bond? Essentially, the U.S. government, we fund ourselves with debt because we spend far more than we take in taxes and fees and collections of various kinds. So we ought to constantly be selling these bonds to fund the government. And we sell 30-year bonds, we sell 10-year bonds, we sell 5-year bonds, we sell 2-year bonds, we sell 1-year bonds, and we also sell T-bills. Now, there's no problem, generally speaking, with the government with T-bills, which are very short term, 30 days, 90 days. Yeah, people are willing to buy that. But once you get past that, once you get past 1 year even, there's a lot of reluctance by the folks that used to buy these bonds to buy 5-year bonds, 10-year bonds. And they definitely are quite reluctant to buy 30-year bonds, right? They're like, you know what? You guys are spending like drunken sailors and have been doing for some time. We don't think you really like, I mean, your currency as a result is not scarce, and we don't want to make a 30-year bet that if I give you $1,000, that $1,000 is going to be worth $1,000 in today's value 30 years from now. Very few people want to make that bet. Not foreign governments, not foreign central banks, not U.S. investors. Very few people want to do it. But nonetheless, we have enormous debt, right? We have $36 trillion in debt, and we overspend, our what we take in taxes, fees, etc., by nearly, somewhere between 6 and 7%. So we got to sell debt. We got to sell debt, and as a result of what is going on in the world of trade, tariffs, it's become very clear to the world that we need to rebalance our finances. We need to start making things. We need to stop shipping dollars and having people just ship all their stuff here, and where people take those dollars and then buy assets. Previously, they used to buy the 30-year bond. They were perfectly happy with it. Why? Well, I mean, because the deficit means our spending over what we took in seemed reasonable to them. It used to be 3%, but after COVID, we blew that out. And governments, central banks, investors all around the world, they're like, yeah, that doesn't look good. I don't really want to make a 30-year bet. I don't really want to make a 30-year bet. I think that there's going to be inflation, and the value of this money 30 years from now is not going to be worth the paper that it's printed on. So that is the issue number one that's telling me that Bitcoin's about to go on a parabolic run, because the general idea that people have had is that, hey, we're going to have this tariff trade war. And in the end, what was supposed to happen is that interest rates were supposed to go down. Short-term interest rates would go down and long-term interest rates go down. Instead, we have the opposite happening. And the reason why the opposite is happening is because pretty much everyone is looking at our deficit and looking at what we want to do and saying, yeah, I don't think I want to sign up for this. So they got to find some way they got to find somebody that wants to buy this, right? And if you look at what stocks are going up, right? I'm going to show you this chart, right? And this is just an example. So this is a chart of JP Morgan. Let me increase the size of this a little bit. JP Morgan, Bank of America, and Wells Fargo. So these are three of these largest banks in the United States. For all practical purposes, they are part of the U.S. government. The U.S. government would never allow these companies to go bankrupt. You could throw in Citibank if you want into there, and those would be the four most systemically important banks. Now you can see, the stock market weakness has been there, but these companies really, they're trading within like an inch of their all-time highs. Why? Well, because the U.S. government is about to force, when I say force, I mean that in quotation marks, but push these companies into buying 30-year bonds, and if necessary, 10-year bonds, by allowing them to start to take on debt. Because the U.S. government can see that the world is quite nervous about the U.S. government taking on a lot more debt. They're like, yeah, I think you've hit your limit. We don't want to lend you money. But our banks, after 2008, they have delevered. They don't really have a lot of leverage, and they can blow up their balance sheet. They can borrow money. And the government's like, hey, you know what? We're going to, deregulate all the regulation that we put into place after 2008. We're going to allow you to open up your balance sheet, but only to buy government bonds. Only to buy government bonds. You can't do anything else just for government. You can't lend it, for real estate. You can't lend it for, I don't know, whatever else you want to do, commercial lending, apartments. No. You can do it for treasury bonds. So that's signal number two. That's signal number two, that the government is preparing to essentially rewire the entire system so that they can continue to keep funding the government. Because They are losing the Chinese central bank as a customer for treasuries. They're losing other central banks in Asia as a customer for treasuries, as we try to, like, reset our economy for, like, okay, we need to start making a few things. We can't just keep shipping out dollars. So people are going to have fewer dollars and to buy things, and they don't want to buy long-term treasuries. They're perfectly willing to park it in treasury bills, but that's a problem for us because we want to be able to have people buy 10-year bonds, 30-year bonds. So we're creating customers, right? The banking system is going to be required, pushed, compelled, regulated into buying these. And that's a signal, right? That we're about to see global flows and liquidity going into these areas. All right. So that is signal number 2.
There's a new bull market in town, but it won't favor the timid or those smitten by old market darlings. No, this bull market is for the bold, those willing to ride new horses into the sunset. We would know. This ain't our first rodeo. To grab the bull market by the horns, get your Trade War Survival Guide available in the description of this video.
2, the first one is that the 10-year bond is blowing out. It's going past 5%. Wouldn't surprise me if it got to 5.5% or 6%. So the government's getting ready for that, and they're like, we better create new buyers. So that's the U.S. banking system through these very, very large banks, and that's being signaled here. And you might be wondering, well, why would the bank stocks be going up? Because you know what? They're going to allow them to essentially borrow unlimited amounts of money, or essentially issue unlimited amounts of money by creating credit, but for the express purpose of buying bonds. So essentially, they can take depositors' money, from you and me, and they can lever it up. So for every dollar they take in from a depositor, the government's about to say, you know what, you can, they haven't issued the regulation, but let's say right now it's between $6 and $8. They're going to be like, you can, now essentially take, for every dollar you have, you can buy $20 worth of treasuries. Why would the banks do it? Well, because, they get interest on that. And so that's going to yank up there's going to just totally boost their earnings, per share. So, it's a good deal for them. And they're like, yeah, we'll do that. So we're about to have this, issuance, of money happen to facilitate all of this. The next signal is our friend gold. Gold prices are on a rocket surge, right? This is the gold GLD ETF, but gold prices are at 3,300, and there is simply no sign that the people who have been buying gold, bidding it up from, $1,500, $1,800 to $3,300, that they have really any interest in selling. In other words, they're not using gold as a speculative asset. They're using gold as a kind of new reserve asset. What's a reserve asset? Essentially, where you put your money into to preserve your wealth as a store of value. Now, prior to, I'll say 2021, when the Federal Reserve, issued all that money into the world, and prior to when, we blew out, the U.S. government's, spending, sending money to everybody, people used to use U.S. treasuries, the 10-year bond, and even the 30-year bond as a store of value, as a reserve asset. But no more. People are like, you know what? You have too much debt. You're spending like drunken sailors, and we don't want to finance it. And especially if you want to rewire, your economies where you're making things versus just simply shipping dollars to us in exchange for assets that we buy from you. Yeah, we don't want to do it. Yeah, the central banks around the world are buying gold. They're buying gold, and they are perfectly willing to bid it higher, from whatever 2,500 to 3,300, and that's another signal that liquidity is moving into these scarce assets like gold, and I will say, Bitcoin as well. The next one that I will get to is Bitcoin itself. Now, I'm recording this on Monday, but Asian time, about 12 hours ahead. So it's still like what, it's Sunday evening around 5 in Eastern Standard Time. By the time you get this, it will be Tuesday. But one of the things that you'll see is that Bitcoin is now at, what? Let me just look at this chart. Is at it's at about $110,000, and like gold, there is very little selling. In other words, there are more and more people who are buying into Bitcoin, not for the speculation, but because it is a store of value. In other words, they're like, yeah, the world's financial plumbing is changing. People are no longer treating treasuries like they're worth what they are worth. They think that the spending is inflationary. They think that 30-year treasuries, you're not really going to get, one for one your money back. It's going to be seriously inflated away. And they're pushing into gold. They're pushing into Bitcoin. In other words, there's a really active bid for scarce assets, things that are provably scarce, like gold, like Bitcoin, right? And the final sort of signal that I'll say is signaling that's going higher is our friend Fanny May, which is now at what? Nearly $11. $11. Now, I have a lot of videos on this channel about Fanny May. I'm not going to go into it. For those who are going to write in the comments, what about what's going on with Fanny May? Nothing's changed, folks. President Trump has said he would release them, and that's going to happen. But why am I bringing this up, and how is this connected to all of this? Well, you see, right, the government essentially controls 80% of Fannie Mae, right? And remember, I was telling you, why would the banks be interested? Why would they do the government's bidding, right, of buying up long-term treasuries? Because it's in their interest, right? So one of the things that the U.S. government knows, well, if the 30-year bond goes to, let's say 6%, 6.5%, 30-year mortgages are very closely tied to 30-year treasury bond yields and interest. So the same thing that's happened with all the banks, right, has also happened with Fannie Mae and its brother, sister, Freddie Mac, which is that they were highly leveraged in 2008. They are now essentially completely unleveraged, deleveraged. They can also blow up their balance sheet. And what is the government going to ask them to do? Well, they're going to ask them, once they are freed from this conservatorship, they're like, hey, we're going to free you, but you need to go back to doing what you used to do before, which is what? Well, one of the roles of Fannie Mae was to essentially provide yield control for the mortgage-backed market. And how to do that? Well, essentially it would buy its own bonds. So in other words, if there weren't enough actual buyers for the bonds that were issued by Fannie Mae or Freddie Mac, they themselves would buy it by borrowing. And because essentially Fannie Mae now and back then and forever is essentially considered like the government, yeah, they can get generally favorable interest rates, which then allow them to earn a spread between what they borrow at and what they get from the bonds that they themselves issue. Now, if everything that I'm saying makes no sense, just let me say that the government is in a big hurry to create clients, customers, buyers for anything that has a long time frame. 30-year bonds, 10-year bonds, 30-year mortgages. Why? Because the market is telling the government, telling investors that, hey, we think inflation's going higher. We want to be paid a higher interest rate if you want us to hold long-term bonds. And that has a big impact on the real estate market. That has a real big impact on the mortgage market. And the government is like, okay, we need Fannie Mae and Freddie Mac to go back to doing what they used to do prior to 2009, before conservatorship, which is going to essentially manage the mortgage market so that we don't have 8 or 10% mortgages, which would completely destroy the real estate market. We need to at least have it be something near here. So government's in a big hurry. They need to set all this up, preferably before more, the 10-year bond, shoots out to 5.5% or 6%, right? And in last week's video, I told you there's kind of like two deadlines going, right? There's the deadline for the trade deals with the rest of the world, which is around July 8th, which is now about 6 weeks away. And then there is the deadline for the trade deal with China, which is, I believe, around August 14th. So you got these two deadlines, which have the potential to unnerve the bond market some more if favorable deals don't come or deals don't come. And so far, there is no sign that countries are en masse willing to sign deals. Right? So there's likely going to be more problems as these dates start to occur. You're probably going to see the 30-year bond continue to push out from 5.1% to 5.25%, 5.5%. And as the China deal, starts to come closer and closer, that deadline comes, it might get closer to 6%. So the government's in a big hurry, right? I mean, they got to do all this. So they got to free Fannie Mae pretty soon. They need the regulation for banks pretty soon pushed out there. And I'm bringing all this up because that's why these stocks are all moving. That's why all this stuff is moving. It's why gold is moving, right? So you piece all of it together, it tells you that it's unlikely that even with all of this, we're going to find enough new customers to replace the Chinese central bank, to replace the buying that was being done by the European central bank, by the Japanese central bank. We're going to have to likely, when the government, once the banks have bought their fill, which they'll take some amount of it, and others have bought their fill, they're going to be like, we still need another, 10% more buyers for treasuries. What are they going to do? Well, we're going to do what we have done for the last 15 years. We're going to essentially issue money out of thin air and go buy the treasuries. In other words, monetize the debt. In other words, create money to buy the debt. And why will the central bank do it? Because while people talk a lot about the Federal Reserve, it's about inflation, the truth is that you go and look at the Federal Reserve, what they really are, the government's banker, right? That's what their job is. Their job is to fund the government. So they will do what is necessary. And what is going to be necessary somewhere between now and I'll say year end is that they are going to need to print, issue, create money out of thin air to make sure that the bonds that are issued by the government, that there is a buyer for, there's no failed auction, there's no panic. And forward-looking investors understand this. Forward-looking investors are anticipating this, and they are bidding up scarce assets. They're bidding up those that will benefit from all of this rewiring, chaos, whatever you want to call it, instability. They're bidding all this up. That's the banks. That's gold. That's Fannie Mae. That's Bitcoin. And I think it will extend generally out into other parts of crypto. I think Ethereum is likely going to be a beneficiary of all of this. So let's now get into some really deep trouble, right? I mean, let me put out some price targets here, because let me invite the trolls to come and tell me how wrong I've been, how many times I've been wrong, and what an idiot I am. So just bring it on. Put the comments here. But I'll say that my view is that the supply shock that we have been expecting for the cycle is now underway. Not going to be underway, it is underway. We're now at about 110,000, and there's no sign that there are sellers. So in other words, the selling has opted out. We now have a clear and present current catalyst driven by the trade war, driven by the fact that people have stopped buying long-term treasury bonds issued by the government, which is a financial crisis of a kind. We know what the solution is going to be. They can't let the government run out of money. They're going to have to issue bonds. They're going to have to issue money to buy those bonds. We can see them paving the way for banks to buy them. We can see them creating, looking to free Fanny May so that, we got, the mortgage bond, the mortgage interest rates covered. So we can see all of this preparation going on, which means that this is, happening, and it's going to happen. So my view is this, which is like, as that first deadline comes for the rest of the world to have cut um, um, deals or with hundreds of countries, we're going to see like, okay, I mean, even if all of those deals are cut, it would mean that all of those countries and their central banks are going to be buying fewer treasuries. So we'll have a sense of this. In other words, maybe it's like, a baseline 10% tariff for everybody. Maybe, it's a mixture. But what we will know is that, with each deal, we have fewer and fewer clients and customers for treasuries. And I believe Bitcoin, gold, and others will surge into that. And I'll throw this out there. So into the July 8th meeting, we're going to get to somewhere near 125,000, let's say a range of 125 to $150,000. But that's just going to be an appetizer. That's just going to be the appetizer, because the big one really is the China deal, August 14th. And as it currently stands, we have a 30% tariff on Chinese goods, and they have, I can't remember, is it a 10% tariff? I can't remember. Whatever it is, the numbers are irrelevant, but one thing, let's just say that the 30% thing gets, locked up into as permanent. That, essentially wipes out, most, not most, let's just say it wipes out 30% of Chinese central bank buying of treasuries. That's a big hole to fill. And the market will, as that August 14th deadline comes up, we will start to see markets start to speculate on what, how many customers are we losing for our treasuries? And also, in effect, how much money will the Central Bank of the United States, the Federal Reserve, have to issue to fill that hole, to fill that gap? And they will start to speculate. And I think into that August 14th deadline, we feel that first real speculative surge. In other words, now it's not just people looking to preserve the value of the money, there's people looking to make money. And I think we'll get like, if not like maybe a 50, I'll say even as 100% surge, which gets us to the $250,000 target, something in there. And yeah, I mean, everybody's going to be skeptical until it happens, and that is fine. But we get there, and then, that's when, I think a lot of retail investors, individual investors will get interested and will start to come in, and they'll get hit by the usual, buy the rumor, sell the news. I mean, so from 250, I don't know, we'll probably see some sort of a correction, as those folks who come in late, they get hit. But that won't be the end of it. There's no way, because we've got a lot of financing that we need to do. I believe, it's somewhere, I mean, our debt is so large, right? It's 36 trillion, and it's got to be refinanced. So if, let's just say, 20% of the old buyers, which is the central banks around the world, don't show up every time we issue bonds, well, all that money has to be created out of thin air, issued out of thin air by the Federal Reserve, and go buy it. So the August 14th will just be a little, it'll be like the first sort of like entree for what's going to happen, because as the year goes on, it becomes clear the Federal Reserve has to issue more and more money out of thin air to simply keep the government working. My view is this is when the parabolic run really begins for Bitcoin, and where we'll go from 250 to 300, 350, 400, and it will keep going, very similar to what happened in 2017, where Bitcoin begins the year under 1,000, ends the year nearly at 20,000, right? In my opinion, it will feel similar. It will be somewhat similar. And it will extend maybe a little bit into 2026. And at some point in time, obviously, everything will be discounted, meaning, everybody will have sort of like anticipated that, we're flooding the markets with liquidity. Clearly, there's not enough, buyers for the 30-year bonds, not enough buyers for the 10-year bonds. And maybe the U.S. government has to do some form of yield control or whatever, which, by itself will make the market panic some more. But I will say that I'll stick with the target that I put out at the halving in 2024, which is that I think there is a better than 50-50 shot of Bitcoin hitting a price in US dollars of $1 million. I'll say better than 50-50. And the reason for that is like, when I originally put it out there, it was really based on just like, the cycles of Bitcoin, where it tend to jump an exponent pretty much every halving cycle. Didn't happen in the previous one, but I felt that that was an anomaly. But today we have a clear and present catalyst, like an entire series of things that are enormous, that are big, that are historical, that are epochal, that can absolutely surge this higher into a period when, this is the traditional period of maximum scarcity. We are now more than 1 month past, the 1-year anniversary of the halving. So that was on April 19th. I'm making this video on May 26th. So, we're in the peak scarcity moment. We are in the supply shock moment. So 1 million, I think better than 50-50 shot of this happening. Obviously, if the Federal Reserve is issuing a ton of dollars, now obviously the value of these dollars are less than what they were, 2 years ago, 3 years ago. Nonetheless, the nominal value of Bitcoin is what we care about. And I think get to 1 million. But I'm going to also say, that I'll say a better than 50-50 shot. I'm going to throw some probabilities out there. And I'll say the likelihood of an undershoot, meaning like it going underneath, I'll put at 20%. And let's throw a target, I'd say, of, the peak being 250, 300,000. That would be an undershoot for me. But you also have to say there's a likelihood, just given the amount of changes, given the amount of chaos that is actually happening, that very few people are focusing on. I think an overshoot is possible too, where the peak price gets to somewhere near $2 million. I understand this all sounds quite delusional, but let's just, focus on what is Bitcoin and what drives price, right? Okay. So one of the things that drives price is the cost of producing Bitcoin, which right now is about 90,000, let's say 90,500, right? And it's selling for 110,000. So this cost of producing Bitcoin, you can say, is a kind of book value. It's mostly a reflective of the energy costs, which are capitalized into Bitcoin. So it's like Bitcoin is like a energy storage mechanism of electricity prices that it takes to produce Bitcoin. So we can see that that's one of the inputs that I use to determine what can the price be? Because you can see over time, if you ran correlations, that the cost of producing Bitcoin is loosely correlated to the market price. Now, it can trade at extreme premiums and extreme discounts, both possible. But if you lock back into this, remember, Bitcoin has to be mined by Bitcoin miners. And so if Bitcoin stays too low, below the price, then, Bitcoin miners are going to go out of business. And we need them to stay in business to obviously mine and process Bitcoin. If it's very high, now you'll have so many people entering the Bitcoin mining business because it's so profitable that the margins go down. So Bitcoin price just tends to find a sort of like not a happy medium. Sometimes it's an unhappy medium, but it is loosely correlated to what it costs to produce one Bitcoin, right? The second one is the halving cycle, right? The halving cycle. So April 19, 2025 was the halving. It cut the reward for mining Bitcoin by half. And what we have seen is at about 1 year after halving, which would be April 19th of 2025, this is the point at which the scarcity starts to become very big relative to the demand. especially if there is going to be a lot of money issuance by the major central banks around the world. Right? I mean, not just the Federal Reserve, there's the European Union, there is the Chinese central bank, there is the Japanese central bank. And one of the things that is common now across all of these countries is, right, they're all enormously in debt. They're all enormously in some form of economic crisis. I mean, people are unaware, but China has a massive problem because they've gone through a real estate bust. Obviously, their export economy is struggling as a result of trade war, and they can't really build much more infrastructure because they're overbuilt. So they have to issue a bunch of money themselves to keep their economy afloat, and some of that money is going to go into Bitcoin for certain. The Japanese economy is in the same position. They have enormous inflation. They have been issuing money to buy their bonds for a long time, so that money will also come into Bitcoin. The European Union, they are now being asked to pay for their own defense. So they got to issue a bunch of money. And we, of course, we've been spending like drunken sailors. So we got all the major central banks around the world all ready to push out huge amounts of money for various different reasons. And we don't need all that money to come to Bitcoin. Even if 3% of the money came in, given the scarcity of Bitcoin, right, and where we are in the halving cycle, we just could see this absolutely enormous run unfold for Bitcoin. So what are the ways to play it? Well, obviously the most obvious way would be to own Bitcoin itself, or the various ETFs will give you the same exposure as Bitcoin. They'll go up more or less 1-for-1 with Bitcoin. So that's play number one. Then there is our friend Marathon Digital, which is the miners. And remember, the miners, they mine Bitcoin, and their prices are right now about 90,000. So my study is that once their margins over their mined Bitcoin are something in the range of 15 to 20%, the market starts to capitalize that into the future, and now the miners start to rip higher. We are so if you look at this chart, which is a 5-year chart of Marathon Digital, you'll see it's bottomed out around 10, and it's already now around 15. And my analysis suggests, not a guarantee, that nobody's going to believe this one, but it's setting up to move, and it will move very fast, and it will move very high very quickly. All right, so it's not just Marathon Digital. It's going to be the various miners in some shape or form. Some of the smaller ones may rip higher. Some of the bigger ones may not go up as much, but nonetheless, the miners would be another play. And then the last way to benefit would be to own what are now called Bitcoin treasury companies, pioneered by our friends Strategy or MicroStrategy. This would be the third way to benefit from what I believe is going to be a parabolic surge in Bitcoin that is underway right now, and that has a better than 50-50 chance of getting to $1 million. I'll say a 20 to 30% chance of actually overshooting past $1 million. And I'll say a 20 to 30% chance of undershooting to, let's just say it's something more modest, 250,000, 300,000. All these would be peak prices. All right. A lot going on in the world. There's a lot happening in our portfolios. This is not the old bull market. I know a lot of people are still highly focused on the old bull market, want to know if those stocks will go up, want to know when they'll go up, don't want to move on to other things. I can tell you what's going on right now can make you a lot of money. So maybe you're not in any of these things. Maybe you're in some of these things. But if you are looking for ideas on what is going to benefit from the current bull market, which are things like Bitcoin, which are things like gold mining stocks, which are things like genetics and others, check into atgdigital.media. That is the website. Subscriptions begin at $9.99. With that, I'm going to say thank you for listening and watching. This is Paul saying thank you and goodbye.